Let's look at a problem that uses depletion, which is the allocation of cost over time that we use for natural resources, as opposed to depreciation, which is used on equipment. We have a company that does some mining. They have a coal mine. They purchased the mine with all the development costs and restoration costs. The resource acquisition was valued at 4,500,000. The uh, company expects to extract uh, 900,000 tons of coal, and we do not expect to receive any salvage value when we cease operations. In the depletion rate, which is similar to the units of production, our first step is to determine the uh, cost for the mine per ton of coal extracted. To do that, we're going to take the cost of the resource, divide it by the number of estimated units we're going to extract, and we will have an extraction rate of $5 per ton. In the current period, the company extracted 240,000 tons of coal. We will then take that and multiply it by our depletion rate. And we have a total depletion cost of $1,200,000. Another way to look at this would be to determine the depreciation expense. The depreciation expense, as opposed to the depletion cost, is going to be based on the number of units that we sold. Well, in this case, there's no difference. We sold all 240,000. Multiply the tonnage sold by the rate, and our depletion expense that will go into the cost of goods sold will be the same as our depletion cost. So we place this in cost of goods sold because the depletion is part of the product cost. Uh, if we have an operating asset that manufactures a product, it would be proper to include that depreciation expense in the cost of goods sold. If we have equipment that is used in the selling or administration of a business, then as opposed to putting the depreciation expense in cost of goods sold, that would be placed in operating expenses. So let's change around this problem a little bit and say, what would happen if we only extracted 200,000 tons of coal, leaving 40,000 tons in inventory? So again, we would look at our depletion rate. Our total cost was 4,500,000. No residual value. We estimate that we will have 900,000 tons of coal. And just like before, our rate of depletion is $5 per unit. We extract 240,000 tons of coal. Our depletion rate is $5 a ton, so our total depletion cost is the same as we calculated before, $1,200,000. However, in this case, we only sold 200 tons of the unit of the coal. we sold 200,000 tons of coal. To find the cost of goods sold, the depletion expense that's going to go into cost of goods sold, we take the number of units sold times the depletion rate, and our depletion expense, which will be part of our cost of goods sold, will be 1 million. The cost that will go into our ending inventory will be the tons that remain in ending inventory, which we said was 40,000, times our depletion rate of 5. So of the 1,200,000 in depletion cost, 1 million will show up on the income statement as part of our cost of goods sold. 200,000 will show up on our balance sheet as part of our inventory.